You had a post that came out on Sunday, October 26th, and it starts off with this lead. And I'm not going to chew into the kind of the core of this because I want you to explain this. But I'll offer a little bit. The lead of your post at LinkedIn is, we're living in two economies right now with the Fed in the middle. And then you say stock portfolios are soaring. Upper income households with equity exposure are watching their wealth climb. Meanwhile, grocery bills and gas prices keep grinding away at lower income budgets, with headline inflation at 3% and core CPI at 3.6%, both drifting higher since March. The pain is real and it's persistent. The gap between the haves and the have-nots is widening. Let's get right into that. What are you seeing out there in the U.S. economy? I guess writ large, but what was it that kind of prompted you to articulate it that way? That we are sort of just kind of almost like a two economy nation at this point.
I mean, who's driving the spending right now? It's not the lower end of the income distribution. They are faced with, first, they saw their rents outpace their wages during the pandemic. They're faced with rising credit card and auto loan delinquency. They're seeing their student debt and student loan delinquency rates rise. They're seeing stubborn inflation with food prices rising rapidly. And so they're hurting. The lower income households are hurting, right? Especially those that are not invested, right? And again, many of them are not invested because, when you're barely able to cover your monthly expenses, it's very difficult to save or invest. It's very difficult to have anything left over to go ahead and put a little away in the stock market, right? And so meanwhile, upper income households, I mean, they saw their portfolios. I mean, from the COVID dip that we were in, the S&P 500 is up over 36%. I mean, it's unbelievable. And even at the pre-COVID height, like pre-COVID peak, we're up like 11%, 12% from from 2019, pre-COVID peak. And so even if you just had your money in the index, right, you're up considerably. You're doing well. Remember that during the COVID times, upper income households also were least affected because, a lot of them were working remotely. They didn't have to go anywhere. They lived in large houses and didn't have to share their space with other people. Some of them became sick, right? And so, and then some of them even got checks from the government, even though they didn't lose their jobs, right? I mean, it was so you're living in an economy where those who are heavily invested, upper income households, are continuing to reap outsized benefits, whereas those at the bottom of the income distribution are squeezed,
right?
And that's why I wrote this post.
So one of the other interesting factors I think that you brought forward, as you were kind of looking at what was going on in this two-piece economy. Was not all bad news for people who are on the lower end, right? I mean, rents are down, right? Or excuse me, rents are up, but they're just not. The rent is not growing as fast as some of the other expenses that that average Americans would have to deal with.
That's right. That's right. I want to elaborate on that a little bit. Look, remember, rents are still a level up, considerably up from where they were before the pandemic, right? But the good news is builders built so much housing during the pandemic, apartments, that rent growth has slowed. So now rent increases, which are traditionally something like 3 to 5% every year, right, have come down. And over the past year, apartment rents, asking rents are up only 1.7%, right? Substantially lower than we've ever seen them, really. And now you have rental concessions everywhere, right? And And Zillow actually forecast that rents could come down in 2026. So you're seeing finally renters getting a little break. And hopefully they're going to get that break in 2026, right? And so I think that's the good news, right? But remember, we're starting from a point of pain, right? Nearly half of all renter households are rent burden, meaning they're spending more than 30% of their incomes on rent, right? They're squeezed. Younger households are facing the return of student loan debt. They have, credit card debt to worry about. They have a labor market that's no longer delivering raises. They have a labor market that's frozen and where it's very difficult to find your next opportunity, where the worker has lost a ton of bargaining power, right? And so they're feeling the pinch right now. And so I think I gave a talk last week at a housing conference. And so I was talking about renters. And so when you're thinking about who renters are today, right?
I want to talk about this. So I like where you're heading with this. I've got a question that's going to come in behind this. And so here we go. Let's go. Where are renters today?
Yeah. I mean, look, they're squeezed. They're really squeezed. And so when you're looking at the mobility rates, right? People moving, people are not moving very much. Moving is costly. And so renters are like, hey, I don't really need to move. I don't need to move because first, it's going to be very hard for me to find a new job anyway. The number one reason people move is a new job. And so if the labor market has slowed down and there's no new jobs being created, well, people don't have a reason to move, right? And so luckily for those renters, the big increase in supply that we saw during the pandemic has resulted in higher vacancy rates. And with higher vacancy rates, renters now have a little bit more bargaining power. The landlords are giving them a little slack, giving them basically rental concessions, and not raising the rent, right? Not raising the rents because they want to keep their tenants. In a time where basically rent growth has slowed tremendously, and there are more open housing, empty apartments out there. And so renters' bargaining power has increased, right? Which is the good news for these renters at this moment where they're financially squeezed essentially, right? And so I think that's what we're seeing right now. That's where renters are at.
Let me pause you there and let me ask you this. I saw a stat, like a figure from over the weekend, and forgive me, I don't remember where I picked this up. I do believe that I considered this credible at the time, credible enough to ask you this question. You always talk about the economy really is about people, right? And a lot of it's the decisions that they make, and a lot of it is simply, whether they choose to educate themselves in a particular way, and whether they are willing to go into the workforce. However, the workforce needs them.
Yeah.
It's
all about the decisions. Usually we get some shocks, right?
But here's the question.
Mess things up. Yeah.
The data point that came out of this, I'll just call it an item that I saw. Okay. Was that, compared with 1960, the home ownership for somebody who's 30 years old is about half of what it was. Then I guess in 1960, about 30% of people who are over the age of 30 or were 30 years old owned a home or had just purchased a home. And today that number is more like 15%. There is a significant portion of younger Americans in particular, professional, educated, who are choosing to live alone longer, choosing to not be married longer, and therefore are doing it on their own, like living on their own, paying for the entire freight of that. What impact does that have? I mean, and that might show up in information that's available to you today.
Yeah, I mean, look, we choose things subject to a budget constraint. And essentially the reason why people are delaying, I'm going to use that word again. I'm going to say delaying home ownership they're not abandoning homeownership. They're delaying homeownership is because of their budget constraints, right? You have a whole generation that came of age during the global financial crisis, was delayed into finding a job, delayed into starting to save for a house, delayed into starting to save for retirement, right? And so now the typical renter is 41 years old, right? Because of the constraint, the affordability constraint, right? And so that is the reason why you're seeing those stats out there, right? Where basically it's much more difficult today to get into a home, to own a home, right? Because it's really difficult financially. And so people are delaying those major life changes like home ownership and marriage and having children, et cetera, et cetera.
All right. Well, I appreciate your thoughts on that. I would like to pick that up again and talk about it going forward.
A whole episode on that. There's also plenty of other reasons.
Yeah.
People are delaying these major life decisions, right? Like marriage and having children.
Yes.
And essentially why the fertility rate is so low and our population is aging. We could do a whole episode on that. And in fact, it's going to be very compelling. I'm excited already.
All right. Well, I'll put that on the docket. All right. Well, we'll call it good for now. For Orphe Divounguy, this has been Chris Krug. Subscribe to Everyday Economics wherever you get your podcasts. And make sure you listen to Dr. O and me each week on the Center Square Radio Hour.